Hi, we're talking about Your Money Matters on NDTV Profit, and my name is Alex Mathew. Is this the right moment to go out and buy a house? The question I'm asking is that, and that's because the scenario that we're currently in is highly uncertain. We don't know the outcome of the geopolitical crisis that's currently underway in West Asia, and we don't know what's going to happen, therefore, to crude oil prices, to markets, and to everything else. So, is it a good idea to buy a house in 2026, or should you hold your horses and maybe push that decision down the line? Are you losing anything by doing that? I'm joined today by Kumar, who's Managing Partner at Zvest Financial Services. Harsh, thanks so much for taking the time. Let me first ask you about this, right? If, suppose you, assume that I'm coming to you for advice, Harsh, and I'm saying that this is a house that I need to buy for my own purposes. I don't intend to use this as an investment. What are the first few questions that you would ask me?
So Alex, you started the introduction by saying that, there is a crisis situation and we don't know how the global uncertainty will pan out. So let me clear out first thing first. So if you look at real estate in India, it's driven by 4 to 5 variables. One is how has been the income growth in the country for last 1 to 2 years, how the interest rates, where we have seen Reserve Bank of India going aggressive in terms of rate cut in last 1 year. How has been the urban demand? Because most of the real estate prices in India appreciate on account of nuclearization of families and then urban demand. And lastly, how has been the supply of quality projects? Now, of late, we have started hearing this question a lot about real estate that you were mentioning, primarily because the last 3 to 4 years, we have seen real estate appreciating a lot. And now we have reached a critical juncture where there is a kind of stagnation in the prices. And that's the reason a lot of people who had FOMO, they are now wanting to enter this. Now, if somebody comes to me and asks that should he or she buy a house which they have been anticipating, my first question is it's not about global factor, it's not about anything else, but it's about are you ready for real estate or not? And when I say are you ready, there are few critical checklists which you should have at your end to see that. First is if you're already paying some EMI, be it on your car loan or be it on anything else, add that EMI to the new anticipated EMI, which you may get on account of taking a mortgage. Put together, both the existing EMIs and the new EMI should not be more than, say, 30 to 40% of your net take home. And here I would want to reiterate net take home and not gross take home. Second, you would have to pay some down payment also when you're buying a house. By paying the down payment, are you reaching a situation where you would not have emergency funds, which is equal to your spending of next 6 to 12 months or not? You should be very clear about it. Third is, are you paying the down payment by wiping out your investment? Say you have invested in stocks, gold, mutual funds. Is it that you are liquidating everything to enter into real estate? Then you need to pause and rethink about it. And lastly, you should also be very clear that how is your job outlook going to be for next 3 to 5 years? So if you're in a business, you should know how your business is going to be impacted because of geopolitical reasons or because of local factors. And if you're working somewhere, you should be very clear whether any change in the world, be it AI or be it anything else, can make you reach a situation where you can either lose your job or where you can see reduction in your salary. Now, if any of these things is, playing against you, then I would suggest you should take a pause and think about it. Second thing you should also be very cognizant about is that when you're buying a house, you should have a view that you would stay in that property for 8 to 10 years. I'll tell you the reasons why I'm saying that. When you buy a house, you have a registration cost, which is 6 to 8%, depending on the state, which is a very high cost. You have a cost of interior, you have a cost of fixture, you have a moving in cost. Now, if you add all these costs, unless you stay for 8 to 10 years in the property, it doesn't make sense because the cost does not get apportioned significantly the way you would have wanted to. Second, you also need to see rental yield in the micro market where you are going to buy. Let's say today you are thinking that you will stay in that house, but after 2 years there is a job situation change and you want to give it on rent. You should be very clear if you're getting good rent or not. And when I say rental check, don't ask the builder, don't ask the broker. Just go to No Broker, just go to Magic Brick, see what are the kind of rents which are prevalent in that micro market. And that will give you an idea whether if you don't stay, you will make healthy yield or not. Also, you need to be very clear if you are over leveraging by going into real estate. On one hand, you may have 2 car loans which are going on. On top of it, you are doing this, and then you are not certain about your job. Now, this is a very deadly situation, and you should avoid that. Now,
But before we get it, so there are several things that you've covered, Harsh, in that, but I want to delve into some of these aspects in some more detail, right? The first and foremost is when you're making this down payment, a lot of people have this as a major life goal. And I think less and less people are now thinking of this as a non-negotiable, or at least they're willing to push things down the line if they feel that they're not ready at the moment. You spoke about when you have to liquidate all of your assets and why that may not be a good idea, particularly in the context that we're in right now, where equity markets have underperformed over the last 2 years. And a lot of people are now saying at this moment that it might be a good idea to allocate more money towards equity. Why is this not a good time to perhaps sell all of your equity or sell off your investments and move into real estate?
So Alex, like I was mentioning, that real estate is not about market uncertainties. It's less about timing and it's more about your situation. Let me explain that a little bit. Now, when you're buying equities, there is an easy way in which you can diversify your equity. You can, in 500 rupees today, buy 50 companies through an index fund, through a mutual fund. In real estate, you're buying a single asset, which is at a single location, in a single micro market where you don't know how the behavior is going to be over 10 years. So maybe, yes, equity is beaten down at this point of time. But what if the real estate that you're going to buy does not yield you any return over next 10 years, not because of any other factor, but because of local factors? So that is about concentration, which I thought I'll touch upon. Second is, like in equity, we talk about price to earning ratio. So when you were mentioning that equity is beaten down, it looks attractive. One of the variables which is at the back of your mind is you would be thinking about price to earning ratios, and which is the relevant ratio, not the most important, but relevant. Similarly, in real estate, we can have price to rent ratio. So where you can take the price of the house divided by the annual rent. Now, there the current ratio in India, which is prevalent, is in the range of around, say, 25 to 40. But if you are getting a house where the price divided by the annual rent is less than 15, similar to equities, it's a good idea to look at that asset overall, not just from staying, but from an appreciation point of view also. But if it is 25, 30, those kind of ratios, then it may take you very long to recover that money. And I don't know whether you will ever make yields which are better than even fixed deposit or not.
So this is from the perspective of an argument of between equity as an investment, obviously, which is what it is, and real estate also as an investment. But I'm speaking about the, not necessary, I'm talking about a situation where you're buying a house that you want to live in, Harsh. And I'm talking about the timing and the scenario as things stand right now. You would hypothetically have saved for the last 5 to 7 years. Let's assume that you started post COVID-19 and you've made a pretty decent, hefty portfolio. Now is the time when you had planned in 5 years, I will buy a house. And this is that moment. My question to you is, should you, given the kind of scenario the market is right now in, and where you normally would reallocate towards equity, still liquidate everything?
I would not suggest. The only advantage of doing that is you end up paying lower taxes because your capital gains would have come down in last 2 months or so. But it's better to pay capital gains on gains rather than not paying taxes because you don't have any gains. So I would not suggest that, because generally when an asset class is beaten down, it is better to give it some time, let it tide over, and then think with a calm mind what you want to do. So there would come times when equity market would look expensive, but the real estate may be hovering around the same price at which you are looking at right now. And at that point of time, if you are wanting to build a physical asset, you can take that call, but not at this point of time, because the risk reward at these levels of equity valuation is more favorable for rewards in the medium to long term.
Speaking a little more about timing, and these are always psychological pressures that come into play, right, Harsh, which is that you look at the market and these are usually very chunky assets, very costly assets, real estate.
Right.
And so therefore you talk about the cost of a property in Mumbai or in New Delhi or even in Bengaluru, which can go upwards of 2 crores or 2.5 crores if you're buying a sizable apartment, right? So you look at the price right now and say, what if in 5 years' time the price is 20% or 30% more? I may not be able to afford it then, so I can stretch a little now. Why is that not the best argument?
Because, Alex, your money is not going to lie idle. So even if you don't buy real estate today, you would be utilizing that money and putting it somewhere else. And that money would also yield the return. Now, you can always have an argument that in real estate, I'm leveraging because by paying 20 rupees, I'm buying a property of 100 rupees. And if there is a gain of 20, 30%, overall, then the same gain can translate to a much higher amount of profit on my base money. But so is the case with equity market, because if equity market delivers better return, then you can leverage your trade there also and make return. What I'm trying to say is that I am not for a moment saying don't have real estate. And there are a lot of advantages of having real estate also, which we will discuss during our conversation. But if you have money which you can earmark for something where you see better appreciation, you can do that rather than looking at a single concentrated allocation at this point of time. Or the third approach could be that you can have a balance of both. You can say that, okay, some amount of money which I have got as a bonus last week is lying with me. I will put it into real estate as a down payment. Remaining, I'll take an EMI, and some amount of money I'll put it into equity market. We don't have the predictive ability of what will do better, but if either of those two do better, at least you would have allocation to one of those two baskets rather than being lopsidedly or skewed allocated toward one asset class.
So suppose in my hypothetical scenario, I've managed to accumulate over the course of the last 5 years by investing both myself and suppose my partner is also investing. We started with a certain amount of capital and we managed to push it up to 75 lakhs to a crore. And you've established a certain base. How much is it okay to dilute from that in order to buy a house? Because you're talking about a situation, Harsh, where the potential to grow from this stage, if I'm investing, and suppose I'm in my 30s, right? These are all hypotheticals, and everybody's scenario, I must point out, can be very different. But I'm saying, in this hypothetical scenario, at 35 or 40, for the next 20 years, this 1 crore could potentially grow very sizably if it continues to remain invested. However, I still need to buy a house. So how much is it okay for me to take out from that? And how much is it okay for me to take away from my longer term goals?
So first thing first, Alex, whatever is your liquid portfolio or whatever is your liquidity, you should chart down how much is your expense going to be if you lose your job tomorrow. So if hypothetically you and your partner lose job tomorrow because of, like I mentioned, AI, or because of geopolitical uncertainty, or because of anything else, then you should have sufficient money to take care of your financial requirement for next 6 to 12 months. So let's say you have accumulated 100 rupees. Your next 1 year expense if you lose job is 13 rupees or 15 rupees. Keep that aside. That you can't touch. That has to be in your contingency basket. Second would be how much of that money at this point of time you would want to continue in equity market, also by not overstretching on your EMI. Now, it should not reach a situation where you take a higher loan and the EMI reaches, 55, 60% of your net take home. That is a stretch for you on a monthly basis. So instead of doing that, you go for an EMI, which is 35, 40% of your overall net income. And remaining amount you can invest in the market through systematic investing also. So that is the second approach which you can look at. Third is that at any point of time, you should not be fully illiquid beyond your contingency fund also. So one is your contingency fund, which is, 13 to 15 rupees, which we discussed. Beyond that, keep, 10 to 15 rupees or 20 rupees as your liquid basket, because there could be some opportunities which might come your way. B, there could be some health emergency which might require some money. I'm not saying that you would not have health insurance, but still there could be some requirement. See, there could be some requirement at a family level which could arise, which you're not anticipating at this point of time. So given all these constraints, maintain a fine balance between how much down payment to have, how much should be the EMI, and how much should you keep as a liquid asset for A, any opportunity, or B, any contingency, in addition to the contingency or the buffer surplus, which you would have marked as your 6 to 12 months of expense.
Understood. One argument, Harsh, that I keep hearing, and it's been more than a decade, I've still kept hearing it, which is that if you're paying rent, then it's money lost. Whereas if you're paying an EMI to buy a house, you're building an asset, and you will eventually own a physical asset. Is there something wrong with that argument?
So I would say that yes, there is a conceptual flaw with that argument. Now, let's look at what is EMI. Let's get to first principle. EMI is interest plus principal that you pay to the bank on a monthly basis for the amount of money which you would have borrowed at one go. Now, in the first few years of your loan, let's say you have taken a 20 years loan, in the first 5 to 7 years, the interest component is going to be much higher than your principal. Now, philosophically, if you see, principal is what is building your asset, and interest is an expense which you're paying, similar to the rent. So, if I have to, bullet point it in, a simple sentence, rent is 100% expense, but EMI is also partially expense and partially investment. Now, the second part of the argument is if you are staying at the same property, let's say you like a house and it's available for you to be taken on rent or to be bought. If you're taking that house on rent, rental yield in India is around 2.5 to 3.5%, while the home loan rate in India is 7.5 to 8.5%, which means in the first few years, the amount of rent that you're paying is one third the interest that you're paying on the loan. Now, in the following year, it changes, but in the first 2 to 3 years, you are actually saving a lot.
Why do you say that? Why do you say that, Harsh? For those people that don't understand the way that EMIs are constructed, do you want to describe why that is?
Because of two reasons. One, like I mentioned, that in the first few years, let's say I'll give you an example with the number. You take a loan of 100 rupees today, and in 100 rupees, the rate of interest is, let's say, 8%. Now, what is the rate of interest on the first month that you would have to accrue for the year is 8 rupees. 8 divided by 12 is your first month interest. Now, if you're taking the same house on rent, the annual rent could be 3 rupees. So if I have to simplify it, I'm not getting into the complicated calculation where each month you are paying principal and your interest component is reducing. But at a simple level, in the first year, the rent you're paying in that house is 2.5 to 3 rupees. Interest that you're paying on the loan is 8 rupees. 3 divided by 8 is almost one third. Now, after 5, 7 years, the calculation changes because your rent keeps on increasing, but your interest keeps on reducing. So after 5, 6, 7 years, you may reach a situation where your rent is higher than the initial interest cost that you would have paid because the interest cost would have come down. But along with that, now let me get into certain finer points. One is the flexibility versus commitment. Let's say you are staying on rent, you get a better job offer. You are in Bombay, you get an offer which is 20 kilometers away. If you are owning a house, you may think that let me not change my job because where I am working currently is very comfortable to me. It's near my home. If your child is getting admission in a better school, which is again 2 hours away from your home, you may again compromise thinking that let me not take that call because it'll be far away from my home. So what you're doing in your mind, you're not taking a decision which is rational, but you're taking a decision which is emotional by keeping real estate as the center point of your decision-making variable. Third is the opportunity cost of capital. You have given down payment, you are giving EMI, and tomorrow market cracks another 10%. The valuation become very attractive like they were in COVID period, but you don't have liquidity to deploy, so you are trapped there. And lastly, what we have discussed earlier, like concentration risk and all those things. And one more thing you should always keep in mind, that when you buy real estate, there are certain additional costs also which come in your mind. So when you're staying on rent, you don't have to pay property tax. That's the headache of landlord. You don't have to bother about repair and upgrades. That's a headache of landlord. You don't have to bother about maintenance, provided it's a part of the rent. Your landlord has to take care of this. Here, everything falls on you and you have to take care of all these costs. So it's not just EMI versus rent, but it is EMI plus a lot of other costs versus rent which you end up paying.
Speaking of other costs, Harsh, and you've probably given advice to a lot of people in this situation, right? And you mentioned this briefly at the start. You were talking about stamp duty, you were talking about certain other costs, brokerage perhaps, you were talking about fixtures. I found that a lot of people do not really calculate this when they say that the cost of a property is 1 crore, say, or the cost of a property is 1.5. I've heard people estimate that you can go at least 30% over that to say that that is going to be the cost of fixtures and tax and everything else that you would have to pay. Is that a fair assessment, or is it more or less?
So, Alex, I would also want to mention one more point, which we didn't discuss till now, and maybe I'll discuss it after this. What is the benefit of taking a loan and an EMI? We haven't discussed.
I want to come to that in just a bit. Before we do, we should establish this.
Right. Right. So, yes, there are two ways to look at it. One is a simple rule of thumb where we say that, okay, whatever is the property value, 20% of that is for interiors and home improvement. But if you would want a more precise calculation, then, it depends on the carpet area. how much you want to spend depending on the quality of interior. So if you are looking at a budget interior kind of a thing, then roughly in a market like Bangalore, Hyderabad, Bombay would be slightly higher, would be around 1,000 to 1,200 per square feet. If you're looking at a mid-range interior, maybe 1,500 to 2,500. If you're looking at a premium interior, then it can go as high as 4,000 to 5,000 rupees per square feet. And if you're looking at luxury interior, then it goes beyond 5,000 rupees a square feet. Now, this luxury interior at 5,000 rupees could actually be, 50 to 60% of the property value if the property is costing 10,000 rupees a square feet. That's the reason I use the word luxury interior. Now, what does it cover? It covers modular kitchen, wardrobes, electrical fitting, false ceiling, furniture, appliances, curtains, all these things are covered in that. And you should also keep one more thing in mind, whether you're buying a new house from the builder or you're buying a resale. If you're buying new house, then the cost of interiors and all increases significantly because you get a bare shell. If you're buying a resale home, then I'm assuming that the first buyer would have put in, these modular kitchen and wardrobe and other things. So maybe furniture cost would be extra for you, but beyond that, a few of the things would have already been covered.
Yeah, that's a fair point. Through the conversation, it's been close to 20 minutes so far, Harsh, and we've pointed out a whole number of reasons why maybe buying a house is not the best idea. But there are several reasons why buying a house could potentially be a good idea as well. And we're not necessarily saying, before people think, and I think it might be a little late in the conversation to say this, but we're not saying that people should not buy and own a house. We're talking about when this should take place. So what are the reasons why somebody should definitely consider taking a house and maybe taking a loan?
Okay. So, Alex, it's a very interesting question. And this is something which we discuss with most of our investors on a regular basis. So, first thing is, if your balance sheet is strong, which means if you don't anticipate job loss, if you're sitting on huge amount of liquidity, and if you are going to stay in that place for, 8, 10, 12 years, then it makes sense for you to buy it because it gives you a lot of psychological comfort. Your family feels a sense of belonging, those kind of things. But if your balance sheet is weak, you're uncertain, you're not sure whether you will be staying at that place or not for a longer period of time, then I think it's better to rent. But there are certain behavioral reasons where I would say that buying a house is a better idea. First is, let's say by nature, you are a spendthrift person. You earn 100 rupees in a month, you end up spending 70 rupees in that. Now, if you're buying real estate, then because of EMI, because of down payment, there is a forced saving which you are doing. Now, it's a behavioral nudge for you, but in the end, you are not a person who's going to do, SIP or who's going to invest into mutual fund because that is not a mandatory thing for you. But once you take a loan, EMI becomes mandatory. So that is an advantage for you. It's a forced asset creation. Second is inflation hedge. Over time, what we have seen is that real estate prices generally move in tandem with inflation. In emerging markets like India, we can have phases when inflation remains high for a long period of time. Right now, we are in a situation where the inflation is benign, but we never know. So in those situations, it's better to have real estate because you have an asset class which is providing you hedge against that. Third is, we discussed it earlier, but I didn't explain it in detail, is the leverage. Now, if you are wanting to buy anything else, let's say you want to do an SIP in equity, you have to put that money entirely from your pocket. You want to buy a 5,000 rupees SIP, 5,000 is debited from your bank account. But in case of house, you can pay 20 lakhs. Remaining 80 lakhs can be leveraged by the bank and you can buy a property of 1 crore. So from that point of view, that becomes a good leverage play. And if real estate appreciates, your return on the original principal becomes meaningfully strong. So these are a few of the reasons where we feel that owning a home also has benefits, but you need to see in a holistic way which suits you better as an investor.
Okay, last question. This is 2 minutes, Harsh, which is that a lot of couples tend to think of buying a house. What are the reasons why people should think of doing it jointly or otherwise?
So, Alex, there are two dimensions to that, and I'll take 1 minute each. First question which should come to the mind is, should the property be in both the names or not? And my answer is definitely it should be in both the names. There is one advantage which is more from an inheritance point of view. Let's say there are two owners and there is no will, and if one person is no more, then the second co-owner becomes the owner, and there is no issue with respect to transmission of asset. But on the other hand, if I own the asset and I don't have any will, and tomorrow I am no more there, then it could become an issue where multiple legal heirs may want access to that property. So that is one important reason. But you can always say that I can create a will and I can get done with that headache. Second advantage is on the financial side. If you are buying property where a female is involved, then in a lot of states, there is a stamp duty concession. If you're taking a loan, a lot of banks, they have a lower rate of interest if a woman is a co-borrower or is the primary applicant. If you are in old regime of income tax, then both the individual or both the partners can claim double the tax benefit. So if you see all these things, then property should be purchased in both the name, and ideally the loan should also be in both the names. So you can max out on income tax advantage, you can max out on stamp duty saving, because even if you're saving 1 to 2% on a 2 crore property, it can be 4 lakhs, which can go for your fixtures and all. So, and lastly, the loan eligibility also increases, because if you're wanting to buy a house which is really expensive beyond your income threshold, then that also helps.
Yeah, it's an important point because you have two incomes to consider. Got it. Harsh, I think it's been a pretty interesting conversation, and ultimately this is a decision that tends to also have an emotional aspect to it, but hopefully we've caused people to think in the right direction. Thanks so much for taking the time.
Thank you, Alex. Thanks to all the viewers.
All right, that brings us to the end of this edition of Your Money Matters. Let us know what you think, and do stay tuned. This is NDTV Profit.